Welcome to the InterMarket Analysis video update. This is a weekly video where I look at other markets outside of the S&P 500 to see if they give us any clues. We also go through an extensive study of growth versus value. When we want to buy low and sell high, we focus on growth. When the market becomes more defensive or getting ready to go down, that's when value tends to outperform. We also look at the valuation of the S&P 500, not only on a historical basis, but also looking forward, because that's what the market uses to justify going higher or lower at that time. This is being prepared for Monday, September 30th. I do have a thing called the SPXInvesting Program. It's up, it's going, there's a website. There's a link below this video that will take you to the website. There's also a link to a video if you want to find out more about the program. Here's an email address if you want to contact me directly to set up a time to talk, or if you have any questions, you're more than welcome to do that. Also, this video here, the InterMarket Analysis video, is just one of many videos I do each week, but the real foundation of my analysis and commentary is the daily video. That's where you're going to find the most up-to-date information, but all of this is meant to tie together. We first look at S&P 500 valuation. First, we look back by looking at the trailing 12 months, or TTM, and we do a ratio of past earnings with current price of the S&P. And over the course of time, there have been PE levels that have been defined that when we're at 20 or above, the market is considered to be expensive. Right now, the S&P is well above this red dashed line, so we are considered to be expensive on a historical basis. Also, to give you a little bit more context, going back to 1980, these are different events and when the market was going up or down, and then what the valuations were at that time. Now, you can see here that we spend a long time, years at a time, above this red dashed line. So we don't use this as a timing mechanism. We just use this for informational purposes to tell us that, yes, the market is considered to be expensive when you look back at past earnings. Another way of looking at this is called the Shiller PE ratio, where it takes a smoothed approach over a period of time. Instead of just earnings as they come out, this looks at 10 years of earnings to try to get a more realistic view of the earnings to price and then the ratio between them. And right now, the Shiller PE ratio is coming in at 36.84. Well, you can see there's a chart here going all the way back to the 1800s, and we're pretty high based on that chart. We also can look at the median and the mean here, which is just under 16 and just over 17. So even looking at it this way, we are still considered to be expensive for the market, but we've been expensive for a long time now. The market doesn't do that. The market looks forward. And based on analyst projections and forecasts, it comes up with what it thinks companies will earn looking out into the future. All of those projections are put together into the S&P 500 to come up with a forward PE ratio. And we're also still above 20 when we look at the S&P 500 ratio. Now, this purple PE ratio, these are the mega cap 8. These are the big monster stocks that really drive the market, like Google, Amazon, Apple, NVIDIA, Tesla, things like that. They're even more expensive, but people are still willing to buy them because even though they're valued very high right now, the expectation is that they will even have a higher valuation looking out into the future as their earnings grow. To give it a little bit more context, we also look at the mid caps, which are at 15.8, right around the fair value level. And the small caps are at 15.3, also at that fair value. Then we do another look at growth versus value. As I said, growth is buy low, sell high. Value is when the market becomes more defensive, typically. First, we look at a pure growth index all by itself. And this is in an uptrend and doing quite well all by itself. Then we look at a value index, which is also in an uptrend when we look at it by itself. Where we get some insight is when we do ratios between the two. Here's growth versus value on the top. Even though it pulled back, growth is still outperforming value. And then we do an inverse of that same ratio by looking to see how value has been underperforming growth. So the market is still favoring growth over value, even though there are periods of weakness here. To get a little bit more context, we look at a long range chart here of a growth ETF versus a value ETF. We also see that even though growth has been pulling back, it's still outperforming value. Here's an inverse of that same ETF showing how value is underperforming growth. Then we look at an index, a growth index versus a value index, also showing how growth is outperforming value. And this is also showing how value is underperforming growth. Then we look at a growth index versus a value index, also showing how growth is outperforming. So we use different lengths of charts. We use ETFs and indexes and different indexes along the way. And we're seeing a confirmation. Even though it's not going really strong right now, growth still continues to outperform value. Then we break this down a little bit here. We look at a growth ETF versus a value ETF. This one's showing a little bit more weakness. It's still outperforming longer term, but we're inside of this rainbow now. We want to see the growth really go up, and that would be more positive for the S&P. Here's value, how it shows how it's underperforming growth, but it's also inside the rainbow. If value continues to go up, that would cause us some concern. If this continues to go down, that would be more beneficial for the S&P 500. Then we break this down even further. We look at small cap growth of value, or it's not really doing all that well right now. Mid cap growth of value is also under some pressure lately. S&P growth of value, this is what I focus on the most. We had been breaking out, but over the last couple of days, we were pulling back. We've been chopping sideways. If this could turn and go up, that would really help the S&P to go higher as well. We keep an eye on inflation. On top, we have a monthly chart of the CRB index, which are commodities. We're going up here, but we're pretty much going sideways with the moving average. Then we do a monthly ratio of inflation versus deflation, and this is still continuing to decline. So on a longer term basis, inflation is still seeming to be under control. We look at a daily chart of the CRB index, which has just gone into a downtrend, even though it had a pretty solid week this past week. And then we look at the Baltic Dry Index. As a general rule, when this is going up, that's more inflationary to ship products, specifically in the Baltics. But lately, we've been just chopping along sideways, not really moving up or down with any conviction. So this is not really producing any inflationary concerns. We keep an eye on other markets, and I really only look at them in this video. I don't really follow aluminum on a daily basis, but it's going back up now, but it's still in an overall uptrend, even though it has been pulling back lately. If this goes up really high, that could be inflationary. Excuse me, I'm having trouble with my voice right now. Also, corn is in a downtrend. We see wheat is in an overall downtrend. We keep an eye on fertilizer, which has been going up, but this is just a 3-month chart here. It's not really going up with any real strength the way we saw it a couple years ago. We keep an eye on oil, mainly for geopolitical reasons, specifically in the Middle East. This is coming down right now, and it's in a downtrend. It's dropped below 70. If we see tensions rise in the Middle East, oil could really go up. We look at a gold to oil ratio, where oil's been going down, gold's been going up, so that's why this ratio is going up. We also look at another ratio, oil to the 10-year yield, and they have a really strong tendency. This is not a ratio, I'm sorry. This is a correlation where they have a real strong tendency to go in the same direction at the same time. So if interest rates are going down, typically oil is going down, and the vice versa of that is true. But right now, the strength of this correlation isn't all that strong. We're seeing the 10-year yield going up and oil going down, and so this relationship is pretty much neutral for the time being. We keep an eye on gas, and it's in a downtrend now because we're in an election year. Heating oil is also in a downtrend. Natural gas is going back up, but it's still in an overall downtrend. Gold set all-time highs this week, just looking at the ETF. It's in an uptrend. And silver is not breaking out to all-time highs, but it's also in an uptrend. We look at the closing value for gold on top, the closing value for silver in the middle area, and we see that there's a pretty strong correlation between gold and silver, which only stands to reason, but this proves it by looking at a chart. Copper tends to do better when the economy is looking better going forward. It was really coming down almost to the point of a downtrend. Now it's starting to go back up. And we look at a copper to gold ratio where copper had been really underperforming. It's improving, but gold's also going up. So we're still seeing this ratio in a longer term downtrend. Then we go all the way back to 1980. The black line here, that's the copper to gold ratio. And we just give it some context by putting the 2-year yield in green and the 10-year yield in red. Interest rates have been coming down, and this ratio, for the most part, has been going down as copper has been underperforming gold, because a lot of times folks get into gold to guard against inflation. We look at a gold to silver ratio on top. When this is going up, gold is outperforming. When this is going down, silver is outperforming. And believe it or not, we can compare it to the US dollar index, and they have a pretty strong correlation. So if this ratio is going down, typically the dollar will be going down. If this ratio is going up, typically the dollar will be going up too. So we can get some insight from that. We look at a daily chart of the dollar index, and it's in a downtrend, but it's still above 100 for the time being. And this is a 3-year chart where we broke down below this downward sloping trend line as the dollar has been under weakness. And the stock market usually likes a weaker dollar. That's more favorable for a conversion rate, and it also helps the import-export relationship with companies that do international business. We look at the euro, which is in an uptrend compared to the dollar. And then we look at the Japanese yen, which had been in a really solid downtrend. Now it's in an uptrend compared to the dollar. The euro is also in an uptrend compared to the dollar. And the dollar index has been under pressure. Then I break these out as individual charts. Here's the euro to the dollar, showing how the euro is outperforming. The Japanese yen, which had been in a downtrend, is now in an uptrend compared to the dollar. And the British pound is also in an uptrend compared to the dollar. We look at some different index ratios. The bar chart here is just the S&P 500, the weighted version of the S&P 500. When the really big companies do well, that drives the S&P 500 higher. Well, to make it more fair, there's a look at the equal weight version of the S&P 500, and we're seeing that the two are pretty much in line with each other now, even though they're on different scales. We're not really seeing that the weighted version of the S&P is outperforming. Earlier on in August, when the market was really going up, it was just a few stocks that were driving the index higher. Now we're seeing more of the rest of the S&P actually perform better. This also looks at the equal weight versus the S&P 500 weighted index. When this is going down, that means the equal weight is underperforming, and now it's starting to even out a little bit more as the rest of the S&P is doing better. Then we look at stocks versus commodities, and stocks are outperforming commodities. Here's an inverse showing how commodities are underperforming stocks. Then we look at the NASDAQ 100, which is now underperforming the S&P 500. The NASDAQ 100 is mostly growth stocks, but they've been underperforming lately. The S&P has 503 stocks. They've been holding up better, and that's why we're seeing this ratio going down. If the NASDAQ 100 was outperforming, we would see this ratio going up, even though both are doing quite well. The S&P just hit an all-time high. Now, the NASDAQ is still up strong for the year, but it still has a ways to go, both the NASDAQ and NASDAQ 100, to hit a new all-time high. The S&P 100, which was really leading the S&P 500 higher, that seems to be working off now as the rest of the S&P is helping to keep the S&P going up. Here's the NASDAQ 100, which is now underperforming the NASDAQ. We look at the NASDAQ versus the S&P 500, where the NASDAQ's been coming on, even though we've seen a recent death cross with this ratio. And then we look at the S&P on top, and then a ratio between the mega caps, the really big companies. That's when we were really going up last spring and even somewhat into the summer, and compare it with the equal weight. Well, this is coming down as the equal weight has been doing better. We look at small caps. We do a ratio between small caps and the S&P 500. That's the red line. And small caps continue to underperform. The blue line is the S&P 500. We look at it here on a straight ratio basis, showing how even though small caps have been trying to break out a number of times in 2024, they just haven't been able to overcome the power of the S&P 500, at least yet. Then we look at small caps compared to the tech sector. When this ratio is going down, that means the tech sector is outperforming. Now, the tech sector hasn't been doing as good lately, and small caps have been doing a little bit better. And that's why we're seeing this ratio really gyrate around lately. We look at the biggest software companies. This is in an uptrend and actually showing a nice up move. Finally, here's the mega cap ETF all by itself in an uptrend and above both moving averages. It's still pretty strong, even though it hasn't come back to take out this previous all-time high. We look at the robotics and AI ETF. This is what all the craze is about now. It's performing really quite well by itself, but it's not really doing all that well when we compare it to the tech sector. Even though the tech sector has been under some pressure and this ratio is going back up, the longer term trend is that the robotics and AI ETF is really underperforming. We look at the Dow Jones Composite Average, which takes the Dow, the transports, and the utilities and puts them together. And a lot of the strength is coming from the Dow and the utilities. The transports are going sideways. We set a couple of all-time highs with the Dow this past week. And the utilities, although not at an all-time high, have been really strong lately, but not the transports. This is the Wilshire 5000, another broad market measure, coming off setting an all-time high on Thursday, but it was down a little bit on Friday. We look at a total U.S. stock ETF, which is 2,651 stocks. It set an all-time high on Thursday, but not on Friday, but it's still looking very strong. And this just shows broad market strength. Low volatility stocks, when you look at them all by themselves, they're in a pretty solid uptrend. But when you compare them to the S&P, they continue to underperform. Now, they were bouncing back up, and we've seen a recent golden cross with this ratio. So this is a little area of concern that we want to continue to watch. The FANG index doing quite well above its 50-day moving average, but still has a ways to go to get back to its all-time high. And we fell back here back in August when we had that big down day. We were able to get back above this longer term trend line, but we're still not able to get above this shorter term trend line. ARK is in a downtrend and just chopping sideways these days. We take out the US stocks in this ETF and just look at world stocks. When you look at them all by themselves, doing quite well, coming off of an all-time high. But when you compare it to the S&P has been pulling back lately, but still overall, it's been outperforming world stocks. Then we look at some other stocks. First, we look at the advanced decline line studies, and I showed this in the daily video. We're looking pretty good with the NYSE common stock, the S&P 500, the mid caps, and the small caps, even though the small caps have not broken out above this previous high yet. Then we look at traditional Dow theory, which just looks at the Dow and the transports. The Dow is just setting an all-time high. We're not seeing that with the transport. So that's a Dow theory non-confirmation. Now, the utilities are doing quite well. It's not on here, but they're not quite back to an all-time high, but they've been strong lately. So if you're a Dow theorist, you would see this as a non-confirmation, and that would be a warning sign to you. But we've been seeing that for pretty much all of 2024. Now, we take a different slant at Dow theory. Instead of using the Dow, we use the S&P 500, which is setting an all-time high. And instead of using the transports, we use the NASDAQ, where it's not back to an all-time high. So this is a negative divergence right now, even when we change it around this way. But then we break it down even more. Instead of using the S&P 500, we use the equal weight, which is coming off of an all-time high. And the equal weight version of the NASDAQ 100, the QQQs, that is also a non-confirmation right now. So this is a little bit of a concern to us. We want the Qs to do better, and they were what was really leading the market higher. That's the NASDAQ 100. But now the S&P 500 shows that the rest of the stocks inside of the S&P are doing better. And so that's positive, but this non-confirmation is negative. The transports just continue to chop sideways, not really helping right now. And they continue to underperform when we do a ratio of the transports to S&P 500. When this is going up, this means that the Dow is outperforming the transports, and that's what we've been seeing here. And then we look at the relationship between the S&P on top and the transports in the middle, and they've had a pretty strong relationship for quite a while, but now it's starting to taper off. So if the S&P is going up, that doesn't necessarily mean the transports are going up as well. They could be going down. Here's a monthly chart of the S&P 500 with another global index of stocks in Europe, Australia, Asia, and the Far East, showing how the S&P on a longer term basis continues to outperform. But we're a little bit concerned about the percentage price oscillator. It's starting to roll over slightly. So longer term, that's more of a concern right now. We'll be watching that. Then we look at bonds. We do extensive studies between stocks and bonds. This is looking at the 7 to 10-year bond ETF, which is in a pretty solid uptrend by itself. Here's a total bond ETF, which is also doing quite well. We look at a stock to bond ratio on a monthly chart. When this is going up, that means stocks are outperforming, even though lately they've been pulling back. We look at a world bond index, which after chopping around for 2023 and into 2024, we're finally starting to break out to the upside. We'll see if we can get above these previous highs here, or previous levels here. And then we look at a daily chart of the bond to stock ratio, showing how longer terms bonds still continue to underperform stocks. These are high yield corporate bonds. You also may know them as junk bonds, coming off of setting all-time highs. These are more conservative bonds, corporate bonds. They're also doing quite well, even though they pulled back lately. And we do a ratio between risky bonds, such as junk bonds, and more conservative bonds. And this ratio has been coming down because we're seeing interest rates starting to come down. The Fed is coming in and cutting rates. And so that would only stand to reason that we would see this ratio come down. But at some point, junk bonds may become more attractive because they give a higher yield, even though there's more risk attached to them. We look at a stock to bond correlation showing that they're having a tendency to go in opposite directions. So if the S&P is going up, generally bond prices are going down, which happens from time to time. And then we have the corporate bond index all by itself looking pretty strong. Here's the 10-year yield with some Fibonacci retracements on here. We're not close to any of the lines. Here's a long-term chart of the 10-year Treasury yield where it had been breaking out to the upside, and now it's starting to come back down. Here's the 30-year yield with some Fibonacci retracement levels, but not near those levels currently. Then we do some studies between the S&P 500 and short-term bonds. When this is going up, that means stocks are outperforming bonds short-term. This is another look, but kind of an inverse here, where we look at 3 to 7 year bonds, which are underperforming stocks. So even 1 to 3 years, stocks are outperforming, and 3 to 7 years, stocks are still outperforming. We look at a broad market measure of short-term bonds, showing how stocks are outperforming here. And we look at another broad market measure with further out bonds, showing how stocks continue to outperform. We look at the tech sector and compare it to 3 to 7 year bonds. We're showing some improvement here, but we're not breaking out of the rainbow yet. We want to see tech doing better to be more positive on the market. We look at a ratio between the S&P 500 stocks versus the 10-year Treasury yield, and this shows how stocks are outperforming the 10-year yield. Junk bonds by themselves are doing quite well and setting all-time highs here. We look at a ratio between junk bonds and government bonds, more conservative bonds. This is the market getting a little more defensive as interest rates are coming down. We're seeing a death cross here where we saw this really outperforming for a long time. Now it's doing better, but if this continues to fall, that means the government bonds are more in favor than junk bonds that can be riskier, even though they give you a higher yield. Here's a daily chart of the different maturities showing how interest rates have been coming down. Here's a weekly chart looking internationally with US, UK, German, and Japanese rates here. And then we look at the volatility of bonds on top as measured by the MOVE index, and then the VIX, which is the volatility of stocks. That's the middle area. And we look at the correlation between the two. Now, this does not measure direction. This just measures volatility. And the volatility correlation is pretty strong currently. We look at a monthly chart of the U.S. long-term bond here, which had been in a downtrend for quite a while. It's finally starting to break out and stay above the moving average long enough for the moving average to start to turn up. So this is showing how bonds longer term are also improving. On the bottom, we look at the bond to commodities ratio, showing how bonds are outperforming. Then we look at the different sectors. First, we look at them by themselves. This is the materials sector, and I just list them in alphabetical order according to their symbol, where materials by themselves are doing pretty good. But they're doing better here, but still underperforming when we compare them to the S&P. Communication, this is one of the growth areas, doing quite well by itself, but pretty much chopping sideways when we compare it to the S&P. This is where a lot of the strength to help the S&P go higher comes from. Energy has been sideways. In fact, we're actually starting to see a decline here. We're dropping below the 50 and 200-day moving average. If we stay below these lines, we could actually see a death cross here. And when we compare it to the S&P 500, energy continues to underperform. Financials doing quite well all by themselves and actually doing okay. We'd seen a recent golden cross here with the financial to S&P 500 ratio. We look at industrials, looking pretty solid all by themselves, doing better, but not quite back to a golden cross here with the ratio with the S&P. The tech sector, this is what really drives the market higher. Tech is a huge part. It's in an uptrend by itself, but not coming back to this previous all-time high. And then starting to underperform here when we do a ratio between the tech sector and the S&P 500. The staples sector in an uptrend when you look at it all by itself. And we just seen a recent golden cross here. Now, this is a cause for concern, but we've been seeing this for a while. When staples outperform the S&P, that could mean that the market is becoming more defensive, getting ready to decline. But we've been watching that for 2 or 3 months now, and it hasn't led to any kind of a substantial decline yet. But we'll keep watching this, and I go through this in the daily videos. Real estate, which is doing quite well in the anticipation of interest rates coming down, and it's actually seen a recent golden cross compared to the S&P. So they like lower interest rates. Utilities, really strong. Sometimes you could call this a defensive area because this is what folks get into when the market is getting ready to decline. But you might also be able to call this a growth area. We have AI, we have all the crypto mining that goes on, we have all the switch over to the green stuff, and it's making utilities more attractive and possibly a growth area. And when we compare it to the S&P, utilities is doing quite well. We look at an S&P to utilities ratio. Typically, when this is going up, that means the S&P is outperforming utilities, and that helps the S&P go higher. This has been going down a lot more lately. Now, the S&P has been going up, and we're wondering about the relationship between these two. Is it defensive or is it growth? And we're still trying to figure that out. But this ratio going down just means the S&P has been underperforming lately. We look at healthcare, defensive area. You have to have healthcare no matter what's going on in the economy. It's doing quite well, but coming back down to its 50-day moving average. And it had been performing better, but now it's starting to underperform again when we compare it to the S&P. Discretionary, the thing that makes life fun. This is really doing well. And this had been a really frustrating area for most of 2024. Now we're starting to see this do better. And a lot of this is coming from Tesla that's been improving lately, but it's still underperforming longer term, even though it's improving when we do a ratio between discretionary and the S&P. Semiconductors, a big part of the tech sector, coming down, dealing with its 200-day moving average, showing some improvement, but it better keep going up here or we might see a death cross with the semiconductors. We look at a ratio between energy and tech, showing how even though tech hasn't been doing as great lately, energy has been doing even worse and still underperforming. We look at growth areas compared to bonds, where we pulled back as the market was more defensive when we had that big down day back in August, showing some improvement now. We're hoping that it will continue if we're more positive on stocks. We look at a ratio between the tech sector and the 10-year yield. The tech sector is still outperforming here. There's an inverse showing how the 10-year yield is underperforming the tech sector. We look at a ratio between discretionary and staples. We want discretionary to do better, and it is, but it's still in a downtrend with this ratio. And here's another look at staples to discretionary, showing how staples have been outperforming, but lately showing some weakness as discretionary has been improving. We look at a ratio between gold and the S&P, kind of chopping around here, but gold is still in an uptrend compared to the S&P, and the dollar's been going down as gold has been going up, so we're seeing this ratio really go up as well. The NYSE composite coming off of setting an all-time high. That's positive, and that's a broad market measure. All stocks, both in the U.S. and internationally, also coming off of a recent all-time high. High leverage loans continue to hold up well. This suggests that the economy is looking good when we use this as a benchmark for economic reasons, because these are very risky loans. Emerging markets underperforming a bit here, but still in an uptrend. The Japanese Nikkei index coming back to this high that was way back in 1989, as Japanese stocks have been doing a lot better. Then we look at microcaps, very small companies, also in an uptrend. Here's Bitcoin, which is in a downtrend, but it has been bouncing back up lately. And we look at the S&P on top and the home builders ETF, and we see that the relationship between the two is usually quite strong. It's coming down a little bit, but we only get concerned with this if we see a really strong negative correlation. We're not quite there yet. And then this looks at world stocks where China's just a lot of things happened this past week where they made a lot of positive announcement in the Chinese market, and it's really helping things there. So we're seeing a real surge in China. Emerging markets are also in an uptrend. Europe is trying to turn and go into an uptrend. Japan is trying to turn up to an uptrend, and the US is also trying to go back up to an uptrend. And what we use to measure this with is called the KST, which is a longer term oscillator. Then we look at InterMarket Analysis, which is the name of this video. Going back to the beginning of 2024, gold is still performing the best, followed by stocks, then oil. Green is the dollar, and blue are bonds based on price. They finally turned positive last summer. Then we look at some correlations between the S&P and the dollar. They're having a slight tendency to go in opposite directions. And you can see that as the S&P's been going up, the dollar's been going down. We look at S&P to oil. Also, this is neutral right now, where the S&P's been going up as oil has been under a little bit of pressure lately. But if things escalate in the Middle East, oil might start to climb. We look at the S&Ps or stocks to the 10-year yield. They're having a tendency to go in the same direction right now. So this is showing lately where the S&P's been going up as the 10-year yield has also been going up. Then we look at a shorter term yield, the 2-year yield, where we're pretty much neutral right now. And then we look at the tech sector to the 10-year yield, also tending to go in the same direction. So tech sector has been going up as interest rates have been going up. We usually see the opposite of that, but lately we've been seeing them going in the same direction. Then we look at some long-term charts. This is a monthly chart of the NYSE composite going up, setting an all-time high above an advancing moving average. And the momentum oscillator that we use here is the Copic curve. That's also in an uptrend. And we look at a daily chart of the record high percent index. This continues to go up. So we have a monthly chart, and if you watch the weekly video, that's positive. And here the daily chart is also positive. We look at the S&P with a monthly chart here. This is also still looking good longer term. And we see the percentage price oscillator trying to turn back up here and be in an uptrend. Here's a daily chart of the S&P above an advancing moving average, and we look at stocks versus commodities down below, showing how stocks are outperforming. Then we look at the S&P and compare it with the global stocks on a monthly basis, showing how U.S. stocks are still outperforming, but the KST has been pretty much flat for all of 2024. Then at the very end, I list those things that are positive, and it's quite a long list. And as it applies to this video, my definition of positive is when the 50-day moving average is above the 200-day moving average. So we have growth and value all by themselves. Copper's in an uptrend. The British pound, the euro are in uptrends compared to the dollar. The Japanese yen is now in an uptrend when compared to the dollar. Gold and silver are in uptrends. The big software companies, the mega caps, the FANG index, the low volatility ETF by itself is in an uptrend. Staples are in an uptrend, which is giving us a little bit of a concern, but we've been watching that for quite a while now. The Dow Jones Composite average is in an uptrend. Bonds, when you look at them based on price, whether it's the total bonds, world bonds, high yield bonds, investment grade bonds, corporate bonds, or junk bonds, they're all still in uptrends. It's some of the ratios that are causing us some concern. The tech sector and semiconductors are still in uptrends, but still have a ways to go to get back to their all-time highs. High leverage loans, that's what we watch to see what do the people that invest in this, what do they think is going to happen with the economy? That's still looking good for right now. The Dow's in an uptrend, just setting all-time highs. The NYSE Composite and Wilshire also setting all-time highs this past week. The Nasdaq and Nasdaq 100 are still in uptrends. Mid caps, small caps, and micro caps are in uptrends. All stocks, both domestic and international stocks, and emerging markets. And then I have the asterisk here to show me that's the end of the list. What's in a downtrend? And this is when the 50-day simple moving average is below the 200-day simple moving average. The CRB index, even though it had a good week, it's still in a downtrend. The US dollar is in a downtrend, both on the daily chart and on the weekly chart, which you'll see in the weekly video. ARK is in a downtrend, really still struggling right now. And Bitcoin is in a downtrend, even though it's been bouncing up lately as well. Thank you. I really hope you found this helpful. Please feel free to check out some of the other videos that are posted. Have a great weekend, and I will talk to you in the next video.